Okay, let's get started. Good morning and welcome to today's Tuesday Market Outlook session. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I am going to be walking you through how I am viewing the current markets. So before we get started, the usual disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, starting off with the major equity indices, as usual, highlighting those key areas of support and resistance to be looking out for. From there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model, look at what sectors are outperforming and underperforming the overall market. We'll take a look at some subsectors of interest that I have for you today, and we'll end today's session with some bullish and bearish market observations. So, starting off with the Fed rate hike probabilities before we get to the equity indices, we can see here that the next Fed meeting is on the 1st of Feb, a couple of weeks away, and the current target rate is 425 to 450. And right now, there's really two outcomes or potential outcomes that we are pricing in. One of the potential outcomes is a 25-point hike, and the other is a 50-point hike, which will take rates to 450 to 475 and 475 to 500 respectively. And right now, markets are pricing in a higher probability of that 25-point hike. We will get actually a bit more confirmation on that today with Jerome Powell's speech, but most likely that is what's happening. We are seeing markets act a little bit more bullish at the start of the year as investors are pricing in lower rate hikes from the Fed. And right now there is a 78.2% probability based on Fed futures of that 25-point hike. That being said, a couple of things can change. Or I would say the two big things that could change this figure would be today's speech, as well as the CPI data announcement on Thursday. We've already navigated through the jobs reports, and the probabilities have pretty much stayed somewhat similar. Even a week ago, 25-point probability for 25-point hike was at around 67%. It's actually increased now after the jobs report. So 25-point hike more likely, yes, and markets are pricing it in, hence more recent bullish price action, but we're not very certain on that just yet. These numbers can change with Thursday's inflation announcement, which is really the biggest number to be looking at. So if we take a look here at the S&P 500 and how price action has really reacted last few days, we had a lot of consolidation in the beginning of the year and end of last year, followed by a bullish day on Friday after the jobs report. And then we saw what was looking like a potential breakout opportunity and a revisit back to the 404 level. However, price did reject 395, bearish price action, and set to open a little bit lower this morning ahead of the speech. Overall, though, I would still view this as consolidation and very neutral price action. I think inflation, that inflation number is really what's going to be moving markets a little bit more violently, and that will dictate whether we have a breakout or a breakdown. So until then, until Thursday, I do expect a bit of choppiness in markets here, especially for the S&P. Now, the upside targets, should we get a lower than expected inflation reading, would be 404 in the short term and potentially even higher. However, if we do get a higher than expected inflation reading, that could see a bit of a shock to the system, and we could see a breakdown below that 380 level. And potentially a continuation lower from there. One thing that I did find quite interesting here on the weekly time frame is, even though, yep, sure, there is a bearish trend line, we are now seeing potentially a higher low. We've had lower lows throughout 2022. We did have the that positive divergence that we spoke about the last few months of 2022. And now we are seeing the potential for capitulation. I was expecting a move lower before we started to see signs for capitulation, but if the next two candles on the weekly time frame stay above that 38.2 fib level at 380, that would, in my opinion, qualify as a higher low, and we could see that capitulation form out. And overall, my thesis would still remain intact for the first half of 2023, which is somewhat more neutral price action. Obviously, there are recessionary fears, and inflation is still a big topic of discussion, although that will naturally diminish as the year goes on. Still, recessionary fears are still going to be there, and I don't necessarily expect a huge breakout above 420 and a revisit back to all-time highs. I do think the next few months we may be in store for more neutral price action, more choppiness in markets. But again, that depends on the economic data that comes out over the next few weeks and the next couple of months. Taking a look here at the NASDAQ 100, looking at the QQQ ETF, and price did manage to find support at this key area at around between 270 and 260. We can see the last two candles before this week were strong rejections. Even the last three, we can see those intra rejections from the 260 level. However, there isn't exactly a lot of momentum. We have seen a strong rejection of that 55-day exponential moving average, and price did manage to intraday move back down to 270. So still, again, not out of the woods to the upside or the downside yet. This is still, again, consolidation. So a break above that 55-day exponential moving average, for me, that's what would signify a breakout and bullish price action, or even above 275. Once we get that, that would open the door for a revisit of 280 and potentially even the 290 level for the NASDAQ 100. In terms of downside targets, let's say inflation is a little bit higher than expected. We expect rates to stay high for longer, or even a higher interest rate hike in Feb. That would easily see the NASDAQ 100 break below 260, in my opinion, and potentially even continue lower, with 236 being the next key area of support. Price may not reach there because it's still quite far way away, but I do think inflation, especially for the NASDAQ 100, because it's made up of so many technology names that have a high exposure to interest rates, that could easily see that breakdown and strong underperformance relative to the S&P if we get higher than expected inflation. IWM, Russell 2000. So we're looking at small caps here. And similar to the S&P, we are seeing that higher low. And see, unlike the NASDAQ, we didn't really get that higher low, whereas for the S&P and small caps, we are getting that higher low form at around the 50% fib level at 170 here. So still not out of the woods again. Price action was very bullish at the start of the day yesterday and moved lower. Price set to open a little bit lower this morning, the last time I checked, and back below its 55-day exponential moving average. Overall, though, price is respecting its key fib levels between 38.2 and 50% fib. Key area of resistance would be at 188. Should we see a market rally in the next few weeks? But we have support not only at 170, but also at this 163 level, which provide weekly support and a bit of a double bottom. Overall, the trend does remain bearish, but we are seeing that capitulation formation here. Price isn't exactly making new lower lows. So this could be where price starts to bottom out a little bit. And even if we do have recession fears for the first 6 months of this year, we could easily still see this act as a floor, but price just not moving higher or breaking up above that 38.2 fib level at 188. So still a fairly neutral view here on the Russell 2000. And so much is dependent on this Thursday inflation announcement, because again, that dictates where interest rates will go. And for 2022, interest rates were the main focus, right? Obviously, that ties into inflation, but interest rates and where interest rates were perceived to go was what was dictating price action. I do expect that to continue for at least for the first quarter for 2023, but that will naturally taper off because we do have some sign of, we do have some clues as to where interest rates will eventually head, and that's around that 5% or 5.25% level. So I don't expect interest rates to play as as much of a critical role for 2023, especially towards the end of the year, than it did for 2022. Right, taking a look here at the VIX. So VIX still remaining quite low here, below that 23 area, below its 55-day exponential moving average. And overall, this is good trading conditions. This is good news. You know, even when we do see declines in the market, the VIX isn't breaking out. So that does tell me that, again, low correlation. It's better to diversify. It was easier to diversify your trades in this current environment. When the VIX was higher, it became impossible to diversify your trades because of the high correlation and high systemic risk. So as long as the VIX is low, that is good news in my opinion. It also does mean, from an options perspective, that options are priced cheaper, generally speaking, across the board. And in that case, usually it's better to be buying options than selling options because you're making less bang for your buck if you sell options. But you know, when I look at the overall market conditions, when I look at the neutral price action, the very choppy price action, you know, from a tactical perspective, I think it still makes sense to sell options, but you just have less opportunities or less trades where you're generating enough income to justify selling an option as opposed to buying an option. So that is how I would view the VIX with respect to options. It is definitely cheap. Options are a lot cheaper. It makes more sense to buy. However, you want to be tactical in your approach, and you know, you want the strategy to work in your favor. And when it comes to neutral price action, selling options tends to provide a much better outcome. Okay, taking a look here at TLT, which is the Treasury Bond ETF. And price, you know, did manage to rally in the last few weeks back to this previous swing low. Overall bearish structure remains intact. And we did see some bearish price action there, followed by a move lower. However, it didn't really revisit that 94 area and actually managed to find support at 100 and is continuing higher, set to open a little bit lower this morning. It'll be quite interesting to see where TLT ends up, especially towards the end of the first quarter. But for now, I do have a more neutral view here on TLT. We know where interest rates are heading. And for that reason, it makes sense that price didn't revisit these lows at 92, but also that doesn't really make sense for, you know, a full-on recovery for TLT. So I still think that 110 area will act as a strong area of resistance, as it has already in the last couple of weeks. And taking a look at the dollar, so very interesting movement here in the dollar, especially with investors more recently in the last couple of days pricing in a more dovish Fed. However, you know, my view was a more bullish view on the dollar in the last couple of days, especially with this price action that we saw before the last 2 days here, where price was finding support at around 103, 104. We saw a bit of market chop and some bullish price action on Thursday. However, price immediately rejected almost exactly that 105.50 level and continuing lower, actually breaking below that area of support. So that invalidates my thesis from last week. And I do think that there's potential for the dollar to continue lower, maybe quite choppy along the way. But, you know, overall, I'd say for 2023, my outlook still remains moderately bullish for the dollar. You know, interest rates will still be high, especially if they're going to be high for longer, and they're going to be higher comparable to the other major currencies and central banks. So for that reason, it doesn't make sense for the dollar to completely collapse below 100. I still think that, you know, even if price does move back down to the 100 level or 102, that area between 100 and 102 should act as an area of support for the dollar. And with the dollar moving lower the last couple of days, we have seen gold continue to grind higher. And also, even when the dollar has moved higher, gold has also continued to move higher. So that inverse correlation isn't really there anymore. And that tells me that investors are flocking to the safe haven assets like gold, which is a safe haven asset, and which is why we are seeing so much momentum in gold. We saw initially this huge move higher, followed by a bit of a retracement to the 21-day exponential moving average. And since then, price has consistently found support near the 21-day exponential moving average and has continued to break above multiple areas of resistance, especially more recently breaking above 171, coming back to retest, strong move higher already. It does look like it has a potential to reach that 177, 178 level in the next few days here for gold. But the main takeaway from this is that investors are rotating into safe haven assets here. And even with gold here on the daily, we are seeing an increase in momentum. Moving on to oil, I'm using the light crude oil futures, the front month rolling contract or continuous contract. And you can see here that overall, the view for oil has been quite neutral to slightly bearish. A lot of that has to do with recessionary fears. But on the bullish side, we have the reopening of the Chinese economy from COVID. Remember, the Chinese government was still enacting a zero COVID policy. And now we are starting to see that change a little bit, or clues of that changing. So on that's the bullish side. On the bearish side, we still have recessionary fears, and that is what is ultimately driving price lower. On the weekly time frame, we can see a decently strong bearish trend, followed by more recently a few weeks of exhaustion, retracement higher back to that $80 level, and then again very bearish price action last week. This does look like it's heading lower with major support sitting at around 61 or so. I don't really expect oil to break below this level just yet. Depends on the severity of the recessionary fears. And I do still expect oil to remain at elevated prices throughout the year. But for now, in the short term at least, we are seeing bearish price action. And even on the daily time frame, we can see even though price has grinded higher in the last few days, it's still below the previous bearish candle open, and that indicates again complete lack of momentum, and it does set up for another bearish move lower here for oil. And if we take a look at sector rotation, we have 8 sectors in the improving and leading category and 3 in the lagging and weakening category. So quite a lot of rotation in the last few weeks. Energy, big mover from the leading category and into the weakening category. And that just speaks to the weakness in oil. A lot of energy companies that have exposure to oil prices are underperforming against the overall market, which is why we are seeing a rotation out of energy. Also, if we take a look at our defensive sectors, we have utilities, we have healthcare, and we have staples. All staples and healthcare showing a little bit of loss in momentum. And that's completely understandable when you consider the fact they've been in the leading category for quite some time. Utilities saw a lot of rotation back into utilities after quite a long period of underperformance. But defensive sectors, again, in my opinion, even though we are seeing a short-term risk-on environment for early 2023, or at least the first few weeks, I still think defensive sectors are going to play a big part in how we navigate through 2023 with all these recessionary fears. So I'm not really looking too much into this rotation for healthcare into the weakening category. If you look at a lot of the healthcare stocks itself, it's because their outperformance was so high that in the weeks prior, that but this pullback that they are currently experiencing is seeing the entire sector rotate into the weakening category. But again, not with a lot of momentum when you look at energy, which has had a big move to the weakening category. Healthcare, a more modest move. We have technology back into the improving category, but not a lot of momentum there. I think technology is looking like it's going to be between this improving and lagging category, and also very much dependent on what happens with interest rates. We have communications and real estate finding some momentum, rotating into the improving category. And we also have discretionary, which again is a weaker sector right now. That just speaks to the fact that there's a lack of consumer spending, and there's most likely going to be a continuation of this lack of consumer spending for the first half of this year. And that naturally will impact discretionary stocks a lot more than others, which is why we are seeing it in the lagging category. because taking a look at some subsectors of interest, a couple of them were from last week's or weeks prior, just giving you an update on them. So the first one is KWEB, which is a Chinese internet ETF. My rationale for this was because it provided diversification away from US securities. And this was towards early December. And we have seen, a breakout above the 27 level, followed by some consolidation, and now already that breakout above 32. I was hoping for a bit of a pullback. We haven't seen that. There seems to be a lot of interest here in this Chinese reopening. And for that reason, KWEB is doing quite well, breaking above 2 resistance levels in a short space of time. A lot of momentum here on the weekly time frame. And even though it is at a previous swing level, I don't believe this 34, 35 level will act as that much resistance. If anything, the next key area is still the level that we talked about last week, which is at $40 level. That is a major resistance level. Moving on to home builders, XHB. So home builders, bullish thesis based on the fact that price was able to stay above the $60 level. And I viewed this more as a credit spread opportunity because if you take a look at, this section of price action, it is range bound, it is neutral, even though we have seen an improvement from, the previous months where price was stuck below 60 and now it's like price is managing to stay above 60. It is still fairly neutral above 60 and range bound with 64, 65 acting as resistance. And yesterday actually proves that even more. We can see bearish price action at that 64 level. So this is where, if you did place a bullish trade when price was near 60, this is where you'd want to get out of it because we are seeing a bearish price action and we could see potentially a revisit back down to 60. And from there, again, it provides a much better risk to reward bullish opportunity. But this is how I would play that range for the home builder ETF. And taking a look at KRE, which is a regional banking ETF, and this has been on my watch list for a while. The last few weeks, I have said I want price to, after this breakdown, I wanted price to revisit that $60 level. I want to see if there's bearish price action at that level, and that would give an ideal risk to reward bearish entry point. And so far, that is playing out quite nicely. I do think this is a good entry point for bearish entry point for KRE for that move lower. First target would be at around 56.50. Secondary target, you're looking at the weekly time frame of around 54. So it is showing that bearish price action, but also keep in mind Powell's speech today, inflation on Thursday. These are huge market moving events that can invalidate this thesis. But for now, I still think, this risk to reward, being able to enter at 59, resistance at 60. So if it does break above that $60 level, it's a very quick close, very limited loss, and it does have plenty of reward, plenty of potential downside here with 56.50 and 54 as the two key take profit zones that I would be looking at. All right, and taking a look at IBB, which is the biotechnology ETF, similar price action to KRE, where we have seen that bullish price action in recent months, followed by a period of consolidation at around that 133 level. 134 was a major resistance level, and we did see plenty of false breakouts, just a lack of upside momentum where price couldn't break above 138. We saw a break back down below that 133, 134 level, failed retest with yesterday's very bearish price action. So huge engulfing candle, taking out a few days of bullish price action. And this would give an ideal risk to reward bearish entry point for that move lower, potentially even back down to 122 support. So moving on to some market observations, we have Visa. So Visa is a bearish trade idea now for me. Reason being, it reacted at that 220, 221 resistance level with very bearish price action. So a strong rejection followed by that move lower yesterday. And I think this, from a risk to reward perspective, it's ideal for that short-term entry point. And I'll be looking at 204 as that downside target. When you look at the risk to reward, if a price does break above 221, you'd want to close out that trade. And fundamentally, Visa is very much dependent on consumer spending, and we know there's going to be a slowdown in consumer spending. So for that reason, I do expect Visa to be on the back foot for potentially a few weeks or the first few months of this year. Also, price has approached an overbought condition with the 50-period CCI at 200. So setting up nicely for a shorter term bearish play. Taking a look at a name that we were looking at for the last few weeks is JP Morgan. So JP Morgan on the weekly time frame, we saw a strong move higher, breaking above 127 and essentially breaking above this bearish structure. Price did manage to pull back and bounce. And right now, if we compare it to last week where price is below 135, now price is at 137, it has rallied quite a bit. However, it is running into that resistance at around 138 or so, and set to open a little bit lower this morning. So for those of you that did trade this, I do think, especially with this volatile week ahead, you may want to close out this trade and just take profits and look on to the next one, because this is more of a profit-taking week or a closing out week as opposed to to opening many more trades with inflation coming out on Thursday. Okay, moving on to MSCI. And MSCI, this is a bullish idea that I had on my watch list for a few days now, and I really wanted to see price break above this 21 and 55-day exponential moving average, which is what we are seeing. But before we get into that, taking a look at the weekly time frame, we saw a significant decline through 2022, finding support at 375, multiple bounces from that support level, positive divergence, and we did see price manage to rally all the way to 525, running into resistance, pulling back nicely, multiple rejections of 450, and moving a little bit higher here. And this week's price action, with price actually breaking above these EMAs, that provides a bit of a breakout opportunity for MSCI, in my opinion. I'll be looking for that move back to 520. I'll probably want to cut losses on this trade should price break below this 455, 450 level. That would invalidate the bullish thesis on this trade. The downside to this is that it would be an expensive trade, 480 per share. That's not cheap. But for those of you that are looking for a potential bullish breakout opportunity, this was one that I came across yesterday. And finally, Dexcom. This was a bullish idea from last week. And the thesis remains intact. The thesis was that price stays above this 110 area. Even if it moves a little bit lower, that's fine, but I really wouldn't want to see it break below 104. Once it breaks below 104, that invalidates the trade. But for now, price is staying above 110. Let's see how it reacts in the next few days. And even if it does break below 110, I would consider closing out this trade early and kind of limiting that loss. But still, bullish thesis remains intact, and you have resistance at around that 122, 124 level, which would be my upside target for Dexcom. But again, let's see how this plays out in the next few days. All right, and with that, thank you so much for joining me today. I hope you all have a great trading week ahead. I will see you tomorrow for an educational webinar, and next week as well for another market outlook. Have a great trading day, everyone.